Hi there, I'm Matt Ishbia, President and CEO of UWM, and this is 3 points. First point, the new capital cushion rule. So after the collapse of several lenders in early 2023, U.S. regulators want to require banks to add billions of dollars to their capital cushion. So they want to change some of the structure, which makes it so it's really hard for banks to do more loans. Now, these rules wouldn't go in place until 2025 or fully in place in 2028, so it's not a today problem. However, this could impact the mortgage industry for years to come, making it harder for banks. Right now, banks aren't winning. The non-banks, the independent mortgage brokers, they are growing and winning. This would only add fuel to the fire, help mortgage brokers grow, help independent non-bank lenders grow and succeed. And honestly, that might be what the regulators are looking for, because they know that non-banks actually do mortgages better than the banks based on the data that they look at. And so it could be part of that, but it's going to change the game a little bit if this goes through. Now, it's not done, it's not through, and a lot of people are pushing back. So I'm not sure what will happen, but if these new capital rules go in place 2025 and by 2027, 28, this will be a big positive for mortgage brokers, mortgage lenders that are non-banks, and even consumers at the end of the day, because they'll get lower prices, lower rates from those independent mortgage companies. Second point, interest rates. So we all know interest rates are high, not only on mortgage, but on everything across the board. And what does that impact? First off, on mortgages, people are still buying houses. As rates go up, yes, less people can afford them, but there's still not that many houses for sale. So people are still bidding on houses. The housing values have not come down at all. People are bidding, and there's a lot of mortgage being done every single day. People are buying homes. There's a lot of business out there. With that being said, you know what else is really high? Credit card debt. Over $1 trillion for the first time in American history on record. So what does that mean? People are still cashing out, even at a 7.25%, 7.5% rate, because their credit cards are 30% or higher in some situations. So understanding the overall market. Interest rates are high across the board, not just in mortgages. And what does that mean for your consumer? It's not about the rate. It's about how much money comes out of their pocket on a monthly basis. And so we're seeing more and more of that, where people are still buying houses, but people are refinancing. And we all know when rates drop, it's going to be a big opportunity for everybody. Third point, FHFA and repurchases with Fannie Mae and Freddie Mac. And so the industry is up in arms right now about repurchases from Fannie Mae and Freddie Mac. FHFA years ago came out and basically did a lot of things to make it so Freddie Mac and Fannie Mae would not push back loans to lenders for illogical reasons, small reasons left and right, or after a 36-month window. It doesn't seem to be working. The industry is up in arms and is very frustrated with the amount of repurchases Fannie Mae and particularly Freddie Mac is pushing back on lenders, right? Fannie Mae and Freddie Mac make billions of dollars a quarter, and as we all know, right now is one of the toughest times in the mortgage industry. They're making billions, and lenders are barely scraping by, but they continue to make them buy back loans for small reasons here, little things that happen on a loan that maybe are not impacting the borrower's success in that loan. So it's interesting to see what's going to happen. FHFA is going to have to step in again because it's becoming a big issue. A lot of trade groups, a lot of people are talking about it, and it's impacting lenders, impacting mortgage people, and impacting consumers at the end of the day as well. Thanks for joining me. I'm Matt Ishbia, President and CEO of UWM, and that was 3 points.